Welcome to another video on macroeconomics. On this video, we're going to talk about what is the role of the financial system. We talked a little bit in the previous videos about how banks and financial institutions act as intermediaries between borrowers and lenders. So we see that the financial system plays a very important role in handling household wealth, making loans, etc., etc. So today we're just going to emphasize the point that a well-functioning financial system is a critical ingredient in achieving long-run growth because it encourages people to save more and it encourages investment. As we saw, investment leads to increases in economic growth, as we saw on our chapter on economic growth. So it also encourages efficiency in those activities. So we want to discuss three basic tasks that are achieved by a healthy, well-functioning financial system. The first one is to reduce transaction costs. What is a transaction cost? Transaction cost is any cost, including, for example, the time, the lawyers you need to hire, accountants, and so on, of making a economic transaction or negotiating an economic agreement. It reduces risk and it also provides liquidity. So let's look at each one of those one at a time. How does the financial sector reduce transaction costs? Well, essentially through the role of financial intermediation that we discussed before. Let me illustrate with an example. Suppose that we need $1 billion to finance an investment project. We're not going to have one person who's saving $1 billion is going to come and negotiate with the firm. Here, I'll give you $1 billion. You can borrow $1 billion from me. Typically, what happens is there's going to be millions of different households who are going to save smaller amounts, and then all of that will be put together and add up to $1 billion, and then $1 billion will be given to a firm. In the absence of the financial system, that firm will have to negotiate individual loans with each household. Will have to sign 1 million different contracts. Will have to sit down. That will lead to a lot of time, a lot of hours for lawyers and accountants signing contracts and so on. The transaction cost for that will be very high. In terms of financial intermediation, how does the bank do that? The bank instead is going to say, here are my terms. If you want to lend me your money, I'll pay you this much interest. And so people just go and lend the money to a bank. And so the bank will pool all of the resources and they will turn around and say, okay, I'm the bank. I will give you a $1 billion loan so you as a firm can achieve your investment opportunity. And so the firm now only has to negotiate with the bank. The bank does the negotiating with the households in a kind of efficient way. And essentially what the bank does is give the customers a menu of ways in which they can lend the money to a bank by fixed term deposits, etc. And so that's essentially a way in which we can reduce transaction costs. Another way that doesn't involve a bank could be the firm could do that directly and borrow directly from consumers, but instead of having to negotiate with them directly, it could issue a stock. So it could tell people, you can become a little bit of an owner of our company. Or it could issue a bond. It could say, I'm willing to borrow money under these conditions. Who wants to lend me? And so by issuing financial assets, sometimes these transaction costs are reduced. And so that's one important task of the financial sector is to reduce transaction costs when pooling funds for big projects. Another important goal or task of the financial sector is to reduce risk. There are some people who are more sensitive to losing than others. The sensitivity to losing economists call risk aversion. So the more risk averse you are, the less you're willing to invest in a risky opportunity. And so why is this important? Let's give another example. Let's suppose you are a small business owner, you have a restaurant or a bakery, and you're thinking about making a capital investment. You want to buy another kitchen or you want to expand your restaurant a little bit. That will be a very significant investment for you. And even though you'll be pretty sure because you know your business that's going to be a profitable investment, there is an element of risk. Maybe you expand the restaurant and the customers don't like it and they don't show up and you go. So from the point of view of a private investor, that's a big amount of risk because you're risking your whole business. So what the financial system can do is intervene and try to find ways in which the restaurant owner can share that risk with other people. So how can it do that? By bringing in other investors through either borrowing the money from the bank or by directly achieving some kind of private deal with investors in the form of some kind of financial asset being issued. So this is, again, a way in which the owner of the restaurant can take this investment opportunity that he wouldn't do if he had to bear all the risk. What is the flip side of diversifying the risk? Now the investor is going to have less risk. It's also going to make a smaller return if things are successful, but if things don't work out, it's going to make a smaller loss. Okay, and that reduces risk. Now, another way in which a business can reduce risk is through what we call diversification. What is diversification? Essentially means do not put all of your eggs in one basket. All right. So let's say you have a company, is very successful, you disrupt a market and you become very, very wealthy, and your company has a very well-functioning business model. Now you may be, okay, you've made it, but now going forward, there's competitors that can enter into your business, and there is a risk that eventually your company, may lose that money. And so what you can do as an owner of the company, say, I'm going to sell a little share of my company to other people who want to participate in these profits, so I don't have all of my wealth attached to this one company, and what I raise by selling a share of this company, I can invest in other companies. For example, if your company was in the oil sector and you're worried that because of the Green New Deal and climate change, oil companies are going to go bankrupt, then you can take some of that money and invest it in green technologies, or invest it in completely unrelated, or even better, negatively correlated investments with the investment you had. And so by being able to invest in different businesses that have negative correlation in their returns, your overall risk goes down. Okay, and so this again is achieved through stocks and other financial assets. Simple example of this could be Ford developing the electric F-150s, oil companies investing in green technologies, Elon Musk decides to sell his share of Tesla and buy Twitter, which essentially is a company in a slightly different business. And so all of these are examples of diversification. Finally, a very important task of the financial system is providing liquidity. What is liquidity? Liquidity of an asset refers to how easily can that asset be used for purchasing goods and services. And so the demand for liquidity is different in different elements of the economy, different participants of the economy. So let's give an example. Suppose you're a firm, you have a very good investment opportunity with a high return, but that's a long-term investment. You need to build a new electric dam, and that's going to take you 5 to 10 years to build, but once that's built, you're going to make a big profit out of selling the electricity. Now, that's a profitable project. As a society, we would like to invest in that because the return is higher than the cost, but what is the concern for the people who are saving? So the firm, in some sense, needs to borrow that money, can only pay it back in 5 to 10 years, but the people giving the loan may have a need for liquidity before that. I'm a private household, I'm saving, I give my money to the bank and tell them, okay, you can lend this money, just pay me a return. But what I'm going to say to the bank is that, hey, maybe in a year, I want to buy something, a new car, and I want this money back. So what the bank does is that it's going to give a long-term loan, it's going to borrow in short term. So that's what we call providing liquidity. The bank is going to act as an intermediary and provide liquidity for those who are saving. If you need this money before, we'll give you the money so you can trade it for goods and services. So that's an example of how banks provide liquidity. It's very important because without this service of the bank providing liquidity, those private savings will not be willing to give the money for a long-term project. So by providing liquidity, we make some business investment opportunities take place that otherwise would not take place. Okay. So that's the final one I wanted to discuss. Let's finish here. Thanks for watching.